Bloomberg is now on your dashboard. With Apple CarPlay and Android Auto, it gives you access to every Bloomberg podcast, live audio feeds from Bloomberg Radio, print stories from Bloomberg News in audio form, and the latest headlines at the click of a button with Bloomberg News Now. It's free with the latest version of the Bloomberg Business app. That's the Bloomberg Business app. Get it on your phone in the Apple App Store or on Google Play. Just download the app, connect your phone to your car, and get started. And it's all presented by our sponsor, Interactive Brokers.
Welcome to the Bloomberg Markets Podcast. I'm Paul Sweeney, alongside my co-host, Matt Miller.
Every business day, we bring you interviews from CEOs, market pros, and Bloomberg experts, along with essential market-moving news.
Find the Bloomberg Markets Podcast on Apple Podcasts or wherever you listen to podcasts and at Bloomberg.com/podcast. Today we had the jolts come in a little lower than expected, so fewer job openings. ISM services, Jess, as we were talking before, came in a little bit better than forecast, better than last month. That's good, maybe Fed-friendly, but I don't know how to put all this together. Fortunately, we have smart people who know how to do that for us. One of them is Jennifer Lee. She's a senior economist and managing director at BMO Capital Markets. And for the folks, the kids that don't know, that's Bank of Montreal back in the day. BMO Capital Markets, a great firm up there in Canada. So, Jennifer, looking at the U.S. economy, what's your take here? I mean, is it a soft landing, a hard landing, a no landing? What's going on out there?
Good morning, and thank you very much, both of you, for having me on. I'm going to stick to what we have been saying for a long time now, which is that soft landing narrative. At least it is up until now. Like this morning's, as you were pointing out, this morning's two reports, the ISM was up and the jolts were down, job openings were down. So but it's not down enough. We still have over 1.4 jobs available for every unemployed American out there. So that's a pretty decent job market overall. We're not seeing, 2 jobs for every one person like we did, last year, but it's still a tight labor market and it's still fairly healthy. ISM services, showing that activity is picking up the most in a couple of months. I mean, this is only the first increase in a few months, but still it shows that, again, this whole soft landing narrative is still playing out, at least for now.
Looking at the ECFC function in the terminal, you can pull up looking at where the consensus among economists that are pulled in the terminal. You can look at annually, also quarterly. If you look over quarterly, though, on a basis, there no longer is a quarter-over-quarter contraction coming into this year. Originally, there was a call for the second and third quarter to see contraction. We aren't seeing that anymore. We're still seeing growth. So I'm curious your thoughts on when there still is this concern, because looking at how the consensus among economists, the probability of a recession is still around 50%. That's pretty elevated compared to if you're looking at, say, other firms like Goldman Sachs that have lowered their calls in recent months. Why do you think there is still so much skepticism and gloominess out there about the trajectory of the economy when you have this juxtaposed against a lot of really strong consumer spending data?
I think it's a great question, and I'm thinking that we've never been in this sort of environment where we have a central bank like the Fed that has been tightening so much in such a short amount of time. This is like a record amount, and yet we're still seeing business investment. It has its ups and downs, of course, but it's still supported by fiscal spending, and it all goes back to the U.S. consumer staying resilient. They're not going to be spending like crazy, in coming months. I think things have already started to dial down. But again, it's that job market. I think it all goes back to having a strong job market, and that goes back to demographics. It goes back to the pandemic. What I was a little bit worried about, I will say, was when I saw the personal income and spending data last week with that very small 0.1% wages and salary increase. And I was like, oh, that's not great. But, it's good in terms for the Fed, but it's not great for the consumer. But as long as, we continue to see steady job growth, continue to see steady wage gains, either 0.1 or 0.5 or whatever, I think that will be a good support system overall for the U.S. economy. Now, we actually polled, by the way, our negative growth rate quite a while ago, and I'm losing track of time here in my old age. But we have pulled it, and again, we're sticking to that soft landing. So we've got growth slowing from that unsustainable, I think, 5.2% growth rate in Q3 down to about 1% in Q4, and then flattening out a little bit around the 0.2s or so over the next first half of next year. But
Jennifer,
again,
Jennifer, talk to us about inflation here. I don't know. I mean, for John Tucker and I, it's all about filling up our cars with gasoline down at the Jersey Shore. And I just filled up for $3.10 a gallon. I feel like inflation's coming down, but I'm guessing the Fed doesn't gauge it on my gasoline intake here, but so how do you think the Fed is viewing inflation and the fight against inflation?
I think it's viewing it with a very cautious outlook. And even though, for example, like last week when Governor Waller introduced the whole concept of rate cuts into the whole conversation, which everyone got super excited about, he didn't, he just said that that was he was encouraged by that number. And it needs, I think he said 3, 4, 5 months before they can start talking about rate cuts. So he didn't even mention that they're going to start cutting rates. He says we need to see a few more months worth of better inflation data before we do anything. So I think they're viewing it with a very cautious outlook. But again, when we have longer term inflationary pressures out there, like from the labor market, we have the working age population globally has already basically peaked, right? So we're seeing a lot of people retiring, a lot of people shifting industries. So there's still that tightness in the labor market. And this is again, a global phenomenon, and certainly that in the US. I think Bloomberg ran a story this morning about nurses being, in short supply as another example of an industry that needs workers. So that's going to cause upward pressure on wages and the labor market. And then I'm going to point to Mother Nature again and climate. That's been causing so much havoc all over the world in terms of floods and droughts. And I think that's going to have, some still upward pressure on food prices and all that. And of course, all the wars are having upward pressure on energy prices. So all of that, I think, still has, I'm a bit worried still about inflation. I'm not going to call it an all clear just yet. And I think the Fed would probably agree.
On Friday's jobs report, we'll also get a reading on average hourly earnings. What are you seeing when it comes to wage growth? Because that is something that we know Fed Chair Jerome Powell is watching really closely.
Mm-hmm. So we're looking for about a 0.3 increase, which is in line with consensus, about 4% year over year. Still steady, but coming down. I mean, because we already know that the economy is slowing. It's not 5.2% anymore. It's probably closer to 1% this quarter. Demand is starting to slow. We're not seeing, 300,000 job increases anymore. So I think wage demands and the fact that inflation, as we just said, is coming down, I think is going to temper demand for earnings. Now, having said that, I'm also a bit concerned just given all the strikes that we've seen over the past year. And I don't remember a time where we saw so many and demands were being met. So that, again, is sort of like that, on the one hand, on the other hand thing, which I shouldn't be doing, but I'm doing it anyway. Overall, slowing demand for labor. But still, there's still that big source overall. So I think it's still going to be steady-ish, but slower wage growth overall.
Jennifer, outside of the U.S., where are you kind of focusing on? Where's the big delta? Is it Europe? Is it Asia? Outside the U.S., where are you focusing?
I'm kind of worried about Europe, frankly, but although this morning I will say that I was a little bit more relieved. It was and we normally don't look at revisions too much for services and composite PMIs because they usually don't change that much. But the fact that they all were revised higher, particularly in the UK as well, back over 50, was a little bit gratifying. And the fact that that last week's inflation rate for the euro area, the lowest in over 2 years actually, and the fact that one of the big Uber hawks herself, Isabel Schnabel, of the vice executive board member of the ECB, actually said that when things change, she changes her mind, and that's I think huge. Coming from her, some of the other hawks, from the Bundesbank, and we haven't heard from Austria recently, but I think they're still very more cautious on the outlook. But I'm still, again, worried about when the ECB will finally drop its hawkish talons. And of course, they still are surrounded by wars over there as well. So that's a little bit worrying. And of course, the UK is actually interesting. The data keep changing. A lot of revisions out there that, and we're seeing a lot of signs changing on growth rates, which is kind of interesting. But the UK is not looking as bad as I would have expected a year ago. So I'm a bit more encouraged on that front.
We only have about a minute left, but if you were able to ask Fed Chair Jerome Powell a question at his press conference next week following the Federal Reserve's decision, what would you ask him?
I would say, sir, with all due respect, assuming no one's in the room, just tell me what exactly is it going to take before you're going to start talking about rate cuts. What will it take? Tell me all the factors. I can put them on my little checklist and check them off.
What do you think should be on top of that list?
How many months of CPI do you need and how much does it need to go down for the 3-month and the 6-month annualized rate before you can start saying, okay, forget it, we're done. We are completely, complete at this point. And I want to see what he thinks about for wages as well on the demographic front. And unemployment generally. How much do you want the unemployment rate to rise by in order to say that you are finally finished?
Jennifer, thanks so much for joining us. Always appreciate getting a few minutes of your time. Jennifer Lee She is a senior economist and a managing director at BMO Capital Markets up there in Canada. Always appreciate getting a few minutes of Jennifer's time here.
You're listening to The Team. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Let's talk about private credit. Certainly a big issue for us here. We like talking about it because the growth in private equity is just so extraordinary. I guess we're all comfortable.
Private credit's around $1.5 trillion quarter
yeah.
of the market. So
yeah, and it really took off.
Shabby.
It really took off after the great financial crisis when the banks started pulling back here. So let's talk to somebody who plays in this part of the sandbox. Huw van Steenis, vice chair and partner at Oliver Wyman. He joins us. Huw, can you give us kind of your view of where we are on the private credit boom out there? Is it overdone? Is it a healthy market? How do you think about the evolution and the growth of private credit?
Well, Paul, thanks for having me on. Now, look, I think there's a big runway still to come in terms of private credit. And I think it's driven by a couple of things. I mean, first, as you just said, Paul, when you laid it out, the banks have been obviously on a bit of a diet over the last decade, and that's really advantaged some of the private credit players. But I think there's another diet to come. If you look at the Fed proposals, the Fed may be asking the banks to take as much as a 35% increase in capital for their investment banking businesses. Right. Now, I'm sure it's going to get watered down, but that's an enormous squeeze, which means the banks need shared assets. And then secondly, you obviously had Mark Rowan from Apollo on earlier today. I think also the regional banks in the States have really got some issues and are selling assets at quite good prices too. So there's an opportunity set of banks shedding assets. And on the other hand, clients just desperate for yield. The biggest source of inflows this year is into private credit. As Jess was just saying, it's grown wildly, but it might double again in the next 2 to 3 years. So for the moment, I actually think the conditions remain very ripe and a really good year for opportunities.
Do you see any sort of red flags brewing within the private credit market at this point?
No, it's a great question. So look, as a long-time banks analyst, any market which grows too fast always creates at least an amber flag, if not red. And look, there's a bit of frothiness, particularly if you look around leverage lending. Prices are becoming tighter. That area is really heavily bid. For the note we put out last week, I worked through that 28 traditional asset managers have either bought another private credit firm or set one up themselves. So there's clearly a bit of frothiness around the leverage lending area. But if I look at the kind of off-the-run deals, whether it's buying bank assets, whether it's more esoteric lending, it still looks quite an attractive spread. So I think the leverage lending is probably the area to look at. And then the second one, of course, is who's the right buyers? Are the buyers ones who understand this is a long-term asset? Because you're basically getting assets which used to be run by a bank, but are now going to get run by a fund manager. Do they have the right skills to work out? Do they understand this asset's going to be illiquid? And as ever in life, we hope that the right buyers buy the right assets, but that doesn't always happen. So that's another area that I'm very watchful for.
Huw, why do you think the banks are allowing this to happen? I mean, when I was at the Chase Manhattan Bank, we made a lot of money in our leverage lending business. I'm not going to let that business go to the private market. What's happening on the other side of the street?
Yeah, do you know, it's a great question, and it is extraordinary that you're getting even some of the US's largest banks setting up new private credit units. It's really a consequence of regulation. The Fed, or in Europe, the ECB, are trying to jack up the capital charges to hold leverage loans on the balance sheet. But it's not also even just holding them; it's also the trading of them. Now, as you know, and you've spoken about in the last few months, there's an intense battle. A discussion going on between the banks and the Fed about what is the right level of capital for the risks they're running. And the large banks clearly think that they've got sufficient capital. But if the Fed were to apply the rules as they're currently proposed, as I said, it's a 35% increase. That's so ginormous. The banks will clearly need to trim their sheets, shed some assets, be more thoughtful about the marginal loan they make. So I think you're right, Paul. It's been a great business. It should be a great business, but it depends. It's kind of in the gift now of what the Fed will do.
Talk to us about the market for private corporate loans, because right now they're facing, obviously, a very high rate environment for the first time since they really boomed in popularity. What do you think this means next year? Because even if the Federal Reserve holds off on raising interest rates, rates are still very elevated. How does that impact that particular quarter of the market?
No, look, I think that is a really good question because, because the debt is mostly floating rate note, so in other words, it's being passed on to the corporate directly. Look, as financing costs normalize, some of the weaker balance sheets are going to be exposed. And you've started to see that even in public markets in the last 3 or 4 months. The trade between the stronger sheets and weaker sheets, even in the S&P, has been quite pronounced, I'd say, since June. But you're starting to see that move through the private credit market. Is it possible? Sorry, it would be surprising if there won't be some challenges for some of the borrowers. And I think that's also, why the larger players will need to know, can they work out the asset? Can they rearrange the debts? Do they want to? How do they bail in equity if they need to? And I think that restructuring element is going to become probably into the second half of next year and beyond, start to become more notable. But the current credit dynamics that we're seeing in these portfolios, and admittedly the data could be better, but from what we can see at the moment, they're still performing quite well.
Huw, I guess my experience is looking at this marketplace that it's been very successful, but it's been focused primarily on the middle market lending. Do you expect to see these private credit funds write bigger and bigger checks going forward?
So definitely we're seeing larger checks. So look, you've seen a $4.8 deal, you've seen a $4.9 billion deal this year. Which would be unthinkable even 5 years ago, let alone beyond that. So you're definitely seeing. Look, in what I think one of the most interesting features of finance is how the winner takes most dynamic that you see in tech and other parts is coming into finance too. You've seen it in the big banks. You've seen it in also some of the big asset managers. And that kind of winner takes most dynamic is coming to private credit too. So look, the top 10 private credit players represent about 40% of the fundraising in the last 24 months. And if anything, it looks like it's going higher. Now, that means they can take on bigger loans, as you said, Paul. But also it means that if you've got a mid-cap bank who maybe has got some of the lending facilities from the Fed that they introduced around the regional bank turmoil earlier this year, if they need to shed a few assets to deleverage their balance sheet, they're going to go to one of these top 10, top 15 firms. So it's not just mid-market lending; it's the larger firms are doing much more, taking opportunities of quirky off-the-run portfolios from banks. And as you saw that with Credit Suisse earlier in the year or last year, I think this is actually a really interesting seam for some of the more skillful players.
Private debt was supposed to struggle when borrowing costs were rising, but that didn't happen. What was the catalyst to make it as successful as it has become in recent years?
Gosh, that's a good question, Jess, because I suppose in a way we've only look, this is the sharpest rate cycle for since 79-81, but it's only really in the last 12 months it's really kicked in. So to be humble, Jess, we haven't yet seen the full seasoned impact,
the lagged effects
of rates. Yeah, we haven't got as Tom will keep telling me, it's the long and variables, isn't it? Which
right.
trip you up. And I don't think we've got there yet. So to be honest, Jess, I don't think you see the evidence. So that's where, look, if you want to be bearish, you can say the season cost coming through will start to be more problematic for some of the mid-market firms, particularly if they don't have other sources of debt available. And in particular, let's be clear, some of the regional banks in the States, you can see in the latest Fed lending surveys and loans, lending rates are slowing quite materially. And so it's not like the banks are going to pick up the slack. So they're going to be more dependent upon private credit. Look, I think like with all of the economy, we've seen corporates and households come into this with a much stronger balance sheet.
Right.
And that's probably why it's taken a bit longer.
All right, Huw, thank you so much for joining us. Great stuff. Appreciate getting a few minutes of your time. Huw van Steenis, Vice Chair and Partner at Oliver Wyman.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Jess, Menton, and Paul Sweeney. We're live here in our Bloomberg Interactive Brokers studio, streaming live as well on YouTube. So you can head over to youtube.com and search Bloomberg Radio. Adding to my argument, my widely held argument here by me, that pound for pound, some of the best money managers are in Milwaukee, Wisconsin, is our next guest, Tom Ognar. It is. I don't know what they're doing out there. Tom Ognar, Senior Portfolio Manager, Managing Director at Allspring Global Investments. It'll always be strong funds for me with Tom. Tom, thanks so much for joining us here, my friend. Talk to us about this market. We had a ripping November, market up over 8%, yields coming down dramatically. Was that it? I mean, where do we go from here?
Yeah, hey, Paul. Great to talk to you again. And yeah, those were the good old days. Boy, it sure seems like we're playing into even the data this morning, this Goldilocks scenario. And I think one of the things I try and do, which I think you always did, which is look over the credit markets and see what they're telling us. And after touching 5%, the 10-year has been ripping downward. And I think even more importantly for us equity investors, credit spreads are hitting new lows for the year. And I think I was looking at it this morning. I think we're all the way back to pre-COVID levels on credit spreads, which means investor risk appetite is up, which is a good thing for equities and a good thing if you're a growth investor.
So what are you advising clients to buy and sell?
Yeah, so we've been telling them, don't miss out. I know it's been a magnificent 7-year, and we've participated with that. We own a lot of those stocks, but we've had smaller mid-cap stocks in the portfolio in trying to find opportunities there. We feel like that probably is the biggest misnomer from a valuation standpoint in the market today. They don't do as well when rates are going up, but if rates continue to go down, as we've seen over the last week or two, you can see small mid-cap stocks really participate in this rally, and I think that's an opportunity. And then the other thing we've been telling them is, yes, technology is important. We like technology stocks, but have diversification in your portfolio.
So outside of tech, Tom, what do you think are some areas? I guess some folks now, after this year and the performance of the Magnificent Seven, they're saying, boy, do I ride these things? Do I try to chase them, or do I just say, all right, I missed that trade. Now let me go find some other good names that maybe have not participated in 2023.
Yeah, we would be barbelling it. So again, I wouldn't be out of those names. I think a lot of them, actually, like an NVIDIA is trading at the lowest PE valuation it has in 5 years. People are doubting the sustainability of the earnings they've been generating. Even if you look over at Amazon, trading about 14 times enterprise value to EBITDA, relative to some of the big media companies, relative to Apple, which trades at, well north of 20 times EBITDA. We think, there's still opportunities there. But I think, go down the market cap, look at places like healthcare, look at some of the things that kind of got destroyed during this GLP-1 phenomenon, which we agree with. Like, there's no doubt that is going to impact healthcare, but it's not going to really destroy the models of other companies. And we think there are opportunities in small and mid-cap healthcare, in particular med tech. And one of the things that I think is really interesting is you listen to some of these conference calls of companies like a J&J, they are talking about ramping up the M&A playbook again, and that can be very good if you in the small mid-cap space.
You also sent us a list of stocks, one of them Amazon, on here, and we're talking about mega cap stocks here. What is it about Amazon that you like?
Well, part of it is they've gotten the religion, right? So they brought in, and I don't think it was a huge surprise to us, but you want to see the execution. They brought in the CEO came over from the AWS side. AWS historically has run 25-30% EBITDA margins, pretty healthy margins for that business. We don't think the retail side gets anywhere near there, but getting it up from negative to zero to pushing mid-single digits now, we think that is a good opportunity. We think the data center AWS business is bottomed out of growth at 12-13%. We know AI takes up a lot of data center space, and we think Amazon, is a good play on that, and that's again one that we think is a reasonable valuation, even with the pretty good move it's had this year.
Yeah, up more than 70% year to date, Paul. AMZN, the ticker on that.
Yep, absolutely. Yeah, absolutely. Hey, how do you view AI in general? It just seems like it became a thing so quickly. and investors were just kind of clamoring and figure out how do they get some exposure here aside from NVIDIA. How do you view AI, and do you have any exposure there that you think is interesting?
Yeah, I think we're believers, and so actually spent all last week talking to companies about it. I think it's like 80% chance this is revolutionary. 20% chance this is just kind of a normal net secular shift within the technology space that isn't as big a deal, but we're pretty big believers. We think the dollars are flowing there. If you look at who's spending the dollars, these are companies who've historically been smart spenders, the Googles, the Amazons, the Metas of the world. And we think it benefits not just the NVIDIAs, and we do think it benefits NVIDIAs, but it's going to start spilling over to other companies. Other semiconductor companies, we think as you go into next generations, in AMD potentially benefits as you move more into inference from training. We think power management is extremely important, and companies like a monolithic power play into that. And then we think database is extremely important in data management, and there's going to be a few different ways to play that. Our biggest position there in the portfolio has been MongoDB. It's had a great run this year. Its valuation has come up, and lo and behold, they actually report tonight. So I would encourage people to wait and digest that news. But we think the growth tailwinds behind that business are being underestimated and undervalued in the market. So we think it's a good opportunity, but I would digest the new data we're going to get tonight.
What are some stocks or industries that you don't want to own?
It's a good question. I think we're still back and forth on consumer, right? I think the most recent data points have been a little better. If you look at the projections for holiday spending, they look pretty good this year, 5 to 12%, which would be pretty healthy. I think we were at 3 to 4% last year. I think it's, so anything above that would be healthy. I think consumers are moving back to internet online spending, which should benefit those types of companies again. And, I think as was mentioned prior to my segment here, that even though the JOLTS data is showing a bit of a slowing in the job market, there's still 1.4 job openings per job loss out there or job seekers. And so it's still a pretty healthy environment if you're a consumer out there. And so it's not the greatest, but it's not too bad. And so I think there's a lot of back and forth there. And so I'd say we're a little more agnostic in that segment. And I'd say you definitely need to be a little picky on what you're investing there. And then I'd say the other area that a little cautious on is what's going on in the industrial segment. We're just hearing of increased tightening there, of companies pulling back a bit. Europe seems like, I don't think it's going in recession, but that growth that had picked up a little bit at the beginning of this year when we talk to companies sounds like it's kind of gone the other way again, and that's pushing kind of 0% growth. And then China, to be fair, has been disappointing all year.
Yep, absolutely. Hey, Tom, thanks so much for taking the time. Really appreciate chatting with you. Tom Ognar, he's a senior portfolio manager. He's a managing director over at Allspring Global Advisors, based just outside of Milwaukee, Wisconsin. Appreciate checking in with him.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Jess, I bought a new car recently, 2024 version, and it's the first new car I bought since 2014. And what I noticed is it's basically a technology platform with four wheels. It's software, it's point and click. It's basically your iPhone with four wheels. It's not so much about the car, it's about the technology. And I'm wondering, who are these people behind all this stuff? Who does all this?
Find out.
We're about to find out. Zhou, he joins us. He's the CFO of ECARX, the NASDAQ traded company. ECX is the ticker based in China. Phil, thanks so much for joining us here via Zoom here. Tell us, just give us the 30,000-foot view. What do you guys do at ECARX?
Thank you, Paul, for having me here. This is Phil. So ECARX actually is a pioneer in design and development and delivery of the best of breed of digital cockpit solution, as well as the full stack software solution and autonomous driving solution for electrified mobility era. So we are in this industry for 6 years already.
Who are typically your customers?
So we have multi customers both in China and outside of China. So in China, we serve for largest customer like Geely Group. At the same time, we also provide our service to Lotus, Volvo, Polestar, and Smart.
So one of my favorite features is the heads-up display. And it's like I'm flying an F-16. It tells me the speed limit and how fast I'm going and all that kind of stuff. I want to change the radio or the whatever, do anything on the entertainment front. It just comes right up on your screen. It's a little freaky, but again, it kind of makes me feel like I'm a fighter pilot or something.
Nice.
So Phil, talk to us about where your industry is going. It just seems like the technology is so extraordinary, making such leaps and bounds here. When I go to the Consumer Electronics Show in Vegas in January, it's basically an auto show, with some PCs around it. Talk to us about where the technology is going.
Yeah, sure. This industry is promising and got a lot of dramatic changes. So the e-vehicle industry already moved from the combustion engine focused to electrified mobility solution, move from the traditional vehicle to autonomous driving focused. So this industry is moving very fast, and now we are entering into an era that the electronic mobility solution with the vehicle solutions combination world. So ECARX is in the right position to support the industry transformation right now.
Talk to us about how the EV market is different in China versus the US.
Yeah, definitely. So China, the new EV market in China is booming. As we can see that we have many new players in the market, and right now, China players actually provide the best of the breed solutions in this industry, not only for the Chinese OEMs, but also they are going abroad. They are going to provide the services in the Euro market, in the US market, to support those global OEMs to grow and thrive.
So it's interesting here. I mean, we just think about all the technology here. Talk to us about your company a little bit. I see the stock down about 60% year to date. What's the story that you're telling your investors here?
Okay, so ECARX actually we are performing pretty well in terms of the financial performance. As we announced in quarter three, our top line revenue growth grew at 50% year over year, and our gross margin dollar also grew 140% year growth. All those strong financial performance indicate that we are in good shape. At the same time, right, for example, we provide our full stack solution to many vehicles. For example, we just support a Lincoln 08, the vehicle to launch in a year, right? We'll provide not only the computing platform, but also will provide the ADAS solution, the autonomous driving control unit, as well as the operating system called Flyme Auto. So basically, with that, we are able to increase the content per vehicle and increase our top line and the profitability as well. So we are long-term focused company. We serve for the customer value. And right now, I would say that our stock price is undervalued, but it's okay. We are working on the customer value enhancement, and we do believe that the investors will see our performance recovery in terms of the stock price.
You talked about in your latest quarterly results about increased demand from international markets. Where have you seen the most increased demand?
So from the international market perspective, I do believe that many traditional OEMs, they would like to take into the new EV market. And that change had taken place largely both in Europe market and the China market. And lots of global OEMs, they would like to play in a big way in China market. So they want the partners like ECARX to support their battle plan in China as well. At the same time, lots of Chinese OEMs would like to explore into their footprint in global market. And ECARX will also support those OEMs to thrive, to have the competition advantage in the global market. So that is what happened. We call it China to global and global to China.
Phil, how was some of the tensions between the U.S. and China, particularly as it relates to technology and technology transfers, how has that impacted your business?
I think the challenge is definitely applied to the industry to many players, tech players in the market. And I think the real issue here is how to address the customer demand. How customer want to have the trusted partner to support their vehicle to succeed in the market. So right now, ECARX also operates globally. So not only in China, but also in Europe, we open up our footprint in UK, in the United States, in Sweden, and in Germany. So we are truly a global company, and we collaborated with lots of customers from the different regions, different countries. So that's why we have confidence to bring a value to the customers, and support their business to grow and win.
Hey, Phil, thanks so much for joining us. I really appreciate getting some of your time on learning about your company. Phil Zhou, he is the CFO of ECARX. The symbol is ECX on the NASDAQ, and you can put that into your Bloomberg terminal and check out the stock.
Thanks for listening to the Bloomberg Markets Podcast. You can subscribe and listen to interviews at Apple Podcasts or whatever podcast platform you prefer. I'm Matt Miller. I'm on Twitter at MattMiller1973.
And I'm Paul Sweeney. I'm on Twitter at PT Sweeney. Before the podcast, you can always catch us worldwide at Bloomberg Radio.